Hello everyone, I am Dr. Meenal Yadav. I am Associate Professor at Lal Bahadur Shastri Institute of Management and Development Studies, Lucknow. Today in this session, I will be discussing about features of financial derivatives. Now, as we have already known that a financial derivative is a financial instrument whose value is derived from the value of an underlying asset. Underlying asset can be anything, it can be actually anything, it can be even a guess that whether there will be a rainfall tomorrow or not, it can be a commodity, it can be gold, it can be silver, it can be share, it can be debenture, it can be anything, anything can be an underlying asset. And when we are going to take my position whether this event is going to happen or not, and I am putting money into it, then we are actually getting into a derivative concept. Now, when this entire underlying asset is a financial instrument, financial instrument means it can be an equity share, it can be a bond, it can be a debenture, then we are talking about a financial derivative. So, a financial derivative is a financial instrument whose value is derived from the value of the underlying asset. Now, there are variety of such instruments which are extensively traded in the financial markets all over the world. This financial derivatives is not a concept, it is not only traded in India, it has been done everywhere in the world, and there are different types of financial derivatives. They can be forward contracts, they can be future contracts, they can be options, and options are also of two types. They can be call option, they can be put option, they can be swaps, etc. So, this is a brief introduction about the financial derivatives and the examples of financial derivatives. Now, whatever types of examples I have mentioned here, each one of them have their own specific feature, each one of them have their own specific characteristic or the quality. Like there will be a different characteristic of a forward contract, there will be different characteristics or features of futures contract, and so will be with the equity share, or so will be with the of the equity stock option. So, they will be different features, but we are going to take them as and when the topic will come, but here we are going to discuss some general features of the financial derivative instruments, right. To start with, a financial derivative is number one, it is a contract. Very important, a financial derivative is a contract, right. Now, when we talk about fixed deposit, what happens in a fixed deposit? Fixed deposit, I have some surplus money, I go to a bank, right, any bank, and I say, look, I am having this 5,000 rupees or maybe any amount of money, I want to give, I want to put away this money from myself for a particular period of time, from 45 days to 6 months to an year and so on, and because I am putting this money to you or I am giving this money to you, I am anticipating a certain rate of interest. So, this is how an FD works. So, how a derivative works? Similarly, if I want to buy an equity share in a cash segment, what I do, I go to my broker, then I ask that please buy maybe NDTV shares at certain price, maybe 520, or maybe Infosys or maybe Wipro at certain amount. This is the order which I give to my broker, and then the amount of shares I want, the price at which I want, I just ask it and I try to buy them, right. So, again my question is that how a derivative works. To understand how a derivative works, we are going to understand its features. So, the first feature is that derivative is a contract. What is a contract? For any contract, like any other contract which we have in our life, there has to be an offer, there has to be an offer, there has to be a genuine legal offer, there has to be an agreement, there has to be some consideration. When I say consideration, it means there should be some amount of benefits which both parties are anticipating for entering into this contract. and mind it, there should not be any coercion, there should not be any fraud, there should not be any misinterpretation. So, like any other contract which we have in our life, derivative is a financial contract between the parties. Okay? So, derivative is defined as a future contract between two parties, right. And when I say between two parties, they can be any parties. This is very important. They, you should not bind yourself that only a very specialist of finance can have a contract with the another specialist of finance. No, when we will be talking about a forward contract can be made between two friends. They can be made between a farmer and a shopkeeper, a farmer and an interest list. So, a derivative is a future contract between the two parties. I explained what are the two parties, and it means that whenever there will be a contract, there will always be a binding. I said, when I am making an offer, whenever there is an agreement, whenever two parties are getting into a contract, it has to have a legal binding. That means it can be enforced by law, right. And whatever the terms and conditions which are being mentioned, they have to be fulfilled in future. So, the future period may be short or long depending upon the nature of the contract. So, the duration can be any duration, it can be of 6 months, it can be of a year. So, as of now, otherwise when we are going to actually study about derivatives, we have to move exactly, right, that future contract is for 3 months and respectively, right. So, second feature for financial derivative is that it derives its value from the underlying asset. This I have explained number of times that derivative, they do not have their own significance. The moment they think of betting, the moment they think of some sort of speculation in the price movement, any two parties will enter into the contract and they will enter for a specific period of time. The moment that specific period of time exhaust gets over, derivatives also finish off their thing. So, their entire value comes from where? Their entire value comes from the underlying assets. As I have mentioned so many times, these underlying assets can be commodities, metals, financial assets, intangible assets, and due to this dependence, the value of derivatives changes as per the changes in the underlying assets. So, as we are moving further, we will be talking about the third feature, that is a specified obligation. The parties entering into the contract have certain specified obligations and they cannot move away from these obligations. Though when we are going to study about forwards and futures, there will be a little I would say some students may find a confusion, but there is nothing to be confused. What happens that the nature of a forward contract is different than that of a nature of a future contract. So, otherwise that this specified obligation, the parties which are entering into the contract, they have certain roles, they have certain obligations which has to be performed. The counterparties who are there in the this contract, they have to perform. For example, if a party is in a future contract, I mean I do not want to get into the details at this point of time, but at this point of situation where in the future contract, the role of both the parties, one party is going to say I am going to I am not going to overcome, or I am not going to fulfill this object of mine or this role of mine or this obligation of mine. This is not done. This is a legal binding, whatever obligation is there, you have to fulfill. But here I would also like to mention that the obligation of a contract, this option contract will be different from the obligation of a swap contract, and similarly the obligation of the parties of the forward contract will be different from the obligation of the future contract. So, what I am saying is that when you are entering into a contract, you have to fulfill the obligations, you cannot move away from them, but the nature of these obligations for the specific derivative or the specific contract will be different. The next is direct or exchange traded. Here also the derivative contracts can be, they can be directly made between the two parties or through a particular exchange, like the financial future contracts, right. Now, here I have mentioned exchange traded derivatives are quite liquid and they have low transaction cost in comparison to the tailor made contracts. Right. So, the contracts, they can be entered directly. Now, I am giving you a small example that suppose if I enter into a contract that these mangoes are very much they are very much liked, they are very much appreciated by most of the Lucknowites, and this Dashehri arm of Dashehri mango is very famous. Now, I may say I may contact this farmer or a producer of these Dashehri aam. I can buy that the entire thing. The whatever will happen, whatever the quantity of mangoes will be there, I will be buying at 500 rupees, for example, or maybe at 50 rupees per kg. Now, the seller will say that okay, fine, we never know, because of the the meteorological department, it is saying that there can be lot of disturbances, there can be lot of winds and everything. So, because of that the this prices of mangoes can be less, there can be lot of problems, and the prices can be for 30 rupees kg. This is what the seller is thinking. I as a buyer is thinking that it can be for 50 rupees. So, we can enter into a contract that fine, on after 2 months, after 3 months, today is April, maybe by 15th of May I will buy 100 kgs of mangoes from you at 50 rupees and you are going to sell me. So, now this is a contract which I am taking, which we are not doing anything legal. In the sense, when I am saying legal, I am saying that there is no intermediary as such, there is no exchange involved in this contract. This is between me and the mango grower, right. Now, if suppose that the prices rise too much, maybe at 70 rupees per kg. Now, the seller will say, why the hell I am going to buy it to sell you at 50 rupees, I am going to sell it at 70 rupees, and he runs away and he just vanishes. So, what I will do? I will just I can't do anything. So, this is the problem with the contracts which we do directly, which we are not, where we are not involving any exchange. Whereas, when I enter into a financial contract, any derivative where I am involving a exchange, then it is there is, you cannot run away, there will not be any default risk. So, for example, the exchange traded derivatives are Dow Jones, S&P 500, Nikkei 225, right, and they are, where are they traded? They are traded at either New York Stock Exchange, and similarly we have Nifty option, S&P Junior, which are traded as Bombay Stock Exchange, and so on. So, I hope you are able to understand that we can enter into a contract either directly or through exchange traded, but both have their merits and demerits, but demerit of a direct contract is more, whereas I do not find any demerit in the exchange traded. They are very transparent, they are very official, and they have all good qualities in them. Next, related to notional values. What is notional amount? Notional amount is an amount which is actually the value of the entire contract. Now, it is different from the market price, it is different from the intrinsic value. Now, what is market price? Market price is a price which depends upon demand and supply. If the demand is more, as I said, prices are going to rise. If the demand is less, prices are going to decrease. What are intrinsic value? Intrinsic value means when we are trying to find out the present value of anything which I am going to receive in future. So, suppose I am going to receive 1000 rupees in April 2022, and if I try to find out the value of that 1000 rupees, that how much that 1000 rupees is going to count today, that is in April 2021, that entire process, the value which I will be getting is the intrinsic value, that is the real value. Now, what is the notional amount? Notional amount here signifies the amount which is the actual total value of the derivative, which is the actual value of the financial the investment I have done, that is the value of the derivative, that is the product. So, this can be, this notional value is for surely different from that of the market value and the intrinsic value. Now, this notional value comes, there is a entire concept of this, because it is based on a concept of leverage. So, which we will be talking about in the later classes. Now, here the delivery of underlying assets are not involved. What happens in the cash segment? If we enter into a cash segment, suppose if I buy the stock of Infosys. So, if I am a buyer, then what will happen? I will be paying the amount to the seller, and seller is going to actually give me the delivery of the stocks. Now, I am not getting into the detail that whether I am an intraday trader or an interday trader, that is different, but in a cash segment what happens? A delivery is taken, the asset has to be delivered, and I have to keep that asset in my demat account. Fine. But here in the derivatives, there is as such nothing called delivery of the underlying asset. For example, if I am trying to make a future contract on let us take Nifty index, or if I am getting into a commodity contract on copper. So, it is not that I am on the date of settlement I am going to actually deliver the amount of zinc or copper, whatever I have entered into the contract. Fine. Here it is like, it is majorly the amount of the balances, the offset of the positions which are taking place, So, in derivatives trading, or when we are taking or making the delivery of underlying assets, this is not involved in the derivatives process. Rather, mostly they are settled by the offsetting the positions. This is what I am trying to explain. They are settled by the offsetting positions. There is no effective limit on the quantity of claims which can be traded in respect to the underlying assets. Here I would like to also tell you that when we are dealing with financial derivatives, they are usually done in lots. Right. Otherwise, in the cash segment, what we do is we can buy one share, we can buy two shares, but here we are not going to buy things in one share, one contract, or the contract should be in lots. Lots can be of 50, lot can be of 100, lot can be of 500. So, here it is not an individual asset which is being traded, it is done in a lot. But again I am repeating that in derivatives, it is only the positions which I am taking. Now, what position? If I will be taking a short position if I am a seller of a derivative. I will be taking a long position if I am a buyer of a derivatives. So, what will happen, that I have entered into a derivative contract, I have entered into a bet that particular event or action or volatility or movement is going to take in this underlying asset, and the time span is given to us for 3 months or maybe 2 months or for 1 month, whatever time span I have selected, and then accordingly what will happen? Then at the end of the 3 months or 2 months or 1 month, whatever time duration I have settled, whatever is the position, if the actually price has risen, then whoever has taken the position that the price is going to rise will be the winner, and accordingly the settlement is going to take place. But actual delivery of the asset is not going to be made. Next, it may be used as a deferred delivery. Deferred delivery means it can be, these derivatives are also known as deferred delivery or deferred payment instruments, because as I said that it is easier to take a short position and the long position in the derivatives. ठीक है, it in comparison to other assets or other securities. So, you can easily take up the positions as per, what happens, as I said that these derivatives are an instrument to hedge against the risk. So, in real market means if I am there in the commodity, or maybe if I am into share of, as I said, at this Infosys. So, I may be a buyer in that position, I may have purchased, but I am having some doubt in my mind whether the price is going to rise or fall, and there is so much of volatility, there is so much of confusion which is there in the market, and the market is rising so much, market is, there is some doubt in the, so I can save myself by getting into a contract in a derivatives market and take a different position. If I am a buyer there, I can become a seller. If I am a seller in a cash segment, I can become a buyer. So, this what helps me to hedge myself against the risk. Moving ahead is the derivatives are the secondary market instruments. So, I am sure that you are aware, my audience are aware of the concept called secondary market. What is secondary market? In any financial market, as we know that financial markets are the markets where you find financial instruments. Now, these financial markets are, their money market depending upon the characteristic, there is a capital market depending upon the characteristic and the nature and the maturity time duration of the financial instruments, we can classify broadly into money and the capital market. And both this capital market has both the segments, the primary market and the secondary market. What do we mean by primary market? Primary market means the market where the instrument, where the financial asset, where the security is made available to the investor for the first time. For the first time, that market is known as the primary market, whereas secondary market, which is commonly known as share market, security market, stock exchange, there these instruments, this derivative instrument, it is a part of secondary market, it is not a part of the primary market. Right. So, here derivatives are mostly the secondary markets instruments and have little usefulness in mobilizing fresh capital by the corporate world, because fresh capital mobilization takes place where? In the primary market. So, if I want to acquire funds, if I am just in a planning phase of expanding and some kind of modernization, if I am into some projects and I require additional capital, then what happens? Maybe I require 500 crores or maybe more than that, 1000 crore rupees, and I have thought of going into a public issue. So, if I go into a public issue to acquire fresh capital, in that scenario, what is going to happen? I have to take a route of primary market. So, this is what is being tried to be explained through this slide, is that in this derivatives are not basically the instrument of primary market, they are the instrument of secondary market, highly very much made for either hedging the risk or capitalizing the risk and earning out of it. In the next slide, we have exposure to risk. Now, as I said, the entire existence, the entire the upcoming of this concept of derivatives came with the concept of exposure of the risk. If there is no risk, then I think derivatives concept will not exist. To hedge against the risk, derivatives come. And I just said in the previous slide was that there are people who wait for the risk to come, and the more the risk, the more actions they are going to take, the more positions they are going to take, and accordingly try to take the benefit and to earn out of it. Right. Now, in the previous slides, few previous slides, I said that there are different types of contracts and you have to then fulfill the obligations as per forward contract, future contract, then there are swaps and there are options. Now, you know what happens, that there is a derivative called forward contract. Now, what happens in forward contract, it is, you know, it is not managed by any specific or any official exchange, right. So, in the absence of that, I gave you that example of that mango seller also, that as he thought that he thought that the prices are going to fall because of the nature weather, because of the weather forecast, he thought that the mangoes will be sold at 30 rupees, whereas I as a buyer was willing to give him 50 rupees per kg. So, we entered into the contract and he was happy about it. But when the day came of delivery, he came to know that the mangoes are now being sold at 70 rupees in the open market. So, he said, why am I going to sell her at 50 rupees? I am going to go and sell at 70 rupees. So, he just ran away. So, when he just ran away, that is the type of what? That is a type of default risk. So, you know, in derivatives there are different types of risk, and you know, and out of that, major risk is your default risk. And as I said, that otherwise the derivatives are managed by the standardized exchanges, they are managed by the proper system, and it is being said that the exchange traded derivatives are increasingly involved. However, still there are so many privately negotiated, customized, over the counter traded derivatives, right. So, what are these? You know, when we are going to move further, we are going to understand these both concepts. And what are these both concepts? The concept is over the counter. What do we mean by over the counter? What are the characteristics of over the counter, and what this over the counter has to do with the derivatives? Similarly, what are exchange traded derivatives? What are their relevance? Right. So, when we are there with the derivatives, we are exposed to the various risks, the operational risk, the counterparty risk, and to the legal risk. The last slide is that the financial derivatives are off balance sheet items. Now, what are off balance sheet items? You know, in a balance sheet what happens? There are assets and there are liabilities, but there are certain items which are neither shown on the asset side nor on the liability side. So, those items, but they do affect the financial position of a company, they affect them, they, you know, and then they can further be converted into a liability. So, they are known as off balance sheet items. So, financial derivatives is treated as an off balance sheet items. So, these were the basic features which we discussed about financial derivatives. We mentioned that they are a contract, their values are defined from the underlying securities, you have to fulfill the obligations, there is an existence of risk, then they are the you know, notional values, and it is a off balance sheet items. So, that is all for this session. Thank you so much.